Hello people, today we are going to learn about periodic inventory system, just in time system, FOB shipping point, FOB destination point, and how to calculate cost of goods sold in periodic system. So let's see. The principle of consistency. The principle of consistency means once a company has adopted a particular accounting method, it should follow that method consistently, rather than switching method from one year to the next. Like if a company has decided to go on a perpetual or periodic system, it should follow that. And also in the same it should also follow the first in first out inventory system, or last in first out, whichever out of the four discussed in my previous tutorial. The company can choose to use any of the four methods for inventory system. Just in time inventory system. This inventory system is when the goods is arrived at the time of manufacturing process. So don't necessarily has to put in the in the stack for a long time. It arrives and it gets into the manufacturing process at the same time. Taking a physical inventory. The primary reason for taking a physical inventory is to adjust the perpetual inventory record for unrecorded shrinkages, losses such as theft, spoilage, or breakage. This is the normal journal entry whenever an inventory arrives: cost of goods sold on the debit side and inventory on the credit side. Obsolescence. Obsolescence is reduces the value of the inventory, meaning if a product is becomes obsolete, we need to write down it, meaning it's no longer a product which is useful for the market. So either you reduce the value of the product and the sale price of the product, or you just write down of the inventory. Lower The other method used is lower of cost or market, that is, adjust inventory value to the lower of historical cost or current replacement cost or current market rate. Goods in transit. There are two kinds of point where title of the purchased product passes from the seller to the buyer. First is FOB shipping point, wherein the title passes to the buyer at the point of shipment. This happens when buyer pays for the shipping. An FOB destination point is the title passes to the buyer at the point of destination. So even if FOB destination point is written, even if the goods bought at the end of the year, just before the year end, it will not be an entry unless and until the mm, good has reached the final destination to the buyer. So title passes only after the goods has reached the buyer. So this is FOB destination point. So the sale is recorded when the title to the merchandise passes to the buyer. Periodic inventory system. In a periodic inventory system, inventory entries are as follows. So here on the purchase date, we just write purchases with a debit entry and accounts payable as a credit entry. Here, unlike the perpetual inventory which we learned in the last tutorial, uh, we are not doing any inventory journal entry as we did in the perpetual. Here we just write purchases as debit and accounts payable as credit. On the sale date, accounts receivable and sale, there is no entry for inventory. So in case of periodic, it is very important to remember that we have purchases and accounts payable, and on the sale date, accounts receivable and sales, which is unlike the perpetual inventory system. The inventory on the hand and the cost of goods sold of the year end are not determined until the year end. So, just like perpetual inventory system, in case of periodic inventory system also we use four kinds of methods. Company can choose any of these four methods based on their needs and usefulness. So, specific identification, average cost, FIFO, which is first in first out, and LIFO, which is last in first out. So let's see one by one. So this is an example of inventory. Given is the beginning inventory was 1000 unit and the cost is was per unit is 5.25 and the total cost. Similarly, the purchase date and number of units and price per unit is given and the total amount is given. So we need to find out the ending inventory total value and the cost of goods sold total value. So let's see how we can do that. By reviewing the actual purchase invoice, Computer Inc. determines that the 1200 mouse pads on hand at a year end have an actual cost of 6400. So in case of specific identification, we have to review the actual physical inventory and find out the invoices and do the entry. So by doing this actual specific identification, they found that the total cost is 6400. So let's see how will it look. Specific identification example. The same example, we will calculate the cost of goods sold. Here we found that ending inventory was, by specific identification, we found 6400. And we already know available for sale was 9725 from the given example here. The goods available for sale is 9725. By specific identification, we found the value for the ending inventory. So, goods available for sale minus ending inventory will give you the cost of goods sold. So, this is what we are doing here. Available for sale, ending inventory, and this is the cost of goods sold. So, this is quite easy. Average cost method. The average cost method is calculated at year end as follows. Total cost of goods available for sale divided by total number of units available for sale. So this is just an average calculation method which you might know. Average cost method example. Using the same example, how we can calculate the cost of goods sold. So goods available for sale is already given. Ending inventory can be calculated by using the average cost method. So average cost is like average of all these dollar prices. By calculating the average, we using this formula, total cost of goods available for sale divided by total units. Uh, add the total divided by total number of units will give you this value. And then the ending inventory, we have the number of units which of ending inventory, we multiply the average cost, and whatever value we get is the average cost of the ending inventory. And then cost of goods sold can be calculated by just doing minus goods available for sale minus ending inventory, or we can again use the same method because we know the number of units for cost of goods sold. So we can use just multiply the number of units with the average cost price to get the value. So that was very simple. Then first in first out method uses oldest cost leads to the calculation of cost of goods sold, and recent cost is used to calculate the ending inventory. First in first out, that means first inventory which we purchased, we will use that price for selling the goods first, and that we'll use that cost price to calculate the cost of goods sold first. in the order of first in and then first out. First in as in first purchases. Remember, start with 1129 purchase and then add other purchases until you reach the number of units in the ending inventory. So first we purchase here on 29th of November, then on 3rd January. So whenever we start selling the product, we should first use this cost price to calculate the cost of goods sold, then moving downward. Here is in the example for selling 600 units using the same example as previous. For 600 sales, we have to use the first in thing. First in was this one, the beginning inventory, which was at 5.25. Since we have 1000 unit which costed 5.25 per unit, we have to first exhaust this one. Since we are buying only 600 units, we can use all 600 from this inventory only and use the cost price as 5.25, which will give you this value, and then we will calculate the rest of the units with their specific cost price and then add it up. We'll get this value, and both of these addition of both will give you the cost of goods available for sale, which is already given. This is just putting everything in the table calculate as we calculated before. Last in first out method uses recent cost to calculate the cost of goods sold and oldest cost to calculate the ending inventory. So remember that in last in first out, start with the beginning inventory and then add the other purchases until you reach the number of units in the ending inventory. So for 600 units, let's see, for 600 units we need to start with the most recent purchase. Most recent purchase was at the value of $5.30 on, what is this, let's see here, uh, most recent purchase, last in first out. So last in was at on November 29th, which is at $5.90. So since we have to buy and we have to calculate for 600 units which was sold, 150 will use for with the value with the cost of 5.90, then 200 with 5.80 calculated here, and 150 with 5.60, and then remaining is 200 plus 150 plus 150 is say 2 3 4 5 $500, 500 units, and another 100 is left. Another 100 will take from January 3rd purchases, which costed us 5.30 per unit. So 100 at 5.30 per unit. So total will calculate by multiplying each of them, and then we'll go get this value. And the remaining inventory will go multiply and get this value. If we add both of them together, it would give us the cost of goods for sale, which is already given before. This is just for completing the table which we calculated before. This is just an errors in measuring inventory. An error in ending inventory in a year will result in the same error in the beginning inventory for the next year. So you can just go through it. If you make a error in ending inventory and you move that entry forward to the beginning of new year, the same will be carried. So you have to be careful whenever to not overstate or understate the inventory. So this gives the positive and negative effect on the overstated inventory. Just like for overstated inventory, will have more gross profit, which is a net income. So we have to be careful on that. Gross profit method. Determine the cost of goods available for sale. Estimate cost of goods sold by multiplying the net sales by cost ratio. Deduct the cost of goods sold from cost of goods available for sale to determine ending inventory. Gross profit method example. In March 2003, Chemico's inventory was destroyed by fire. Chemico's normal gross profit ratio is 30% of net sales. At the time of fire, Chemicals showed the following balances: sales of 31,500, sales returns of 1,500, beginning inventory of 12,000, net cost of goods sold is 20,500. So let's see how we can calculate. So it's given that beginning inventory is 12,000, and it's also given that net cost of goods purchased is 20,000. So total goods available for sale will be the beginning inventory plus goods available after the purchase. So total is 32,500. And we are also given that with sales of 31,500 and sales return of 1,500. So deduct that 1,500 from the sales to get the net sales. And it's also given that we have 30% of gross profit ratio, so that means 70% is the cost of goods sold. So we will just multiply 70% from the net sales, and whatever amount is we get is the estimated cost of goods sold, which we will deduct from the goods available for sale, which will give us the answer for estimated March inventory loss. This is the method to calculate inventory turnover rate. Inventory turnover rate measures how quickly a company sells its merchandise inventory. So merchandise turnover is equal to cost of goods sold divided by average inventory. And average inventory is calculated as beginning inventory plus ending inventory divided by 2. A ratio that is low compared to competitors suggests inefficient use of assets. Accounting methods can affect the analytical ratio. Remember that identical companies that use different inventory methods, example FIFO and LIFO, will have different inventory turnover ratios. So guys, I hope you got some insights on the periodic inventory system. So subscribe to my channel if you want to learn more about accounting and other geek topics. Thanks for watching.